Pepkor is planning to shake up the banking sector. The retail giant has been given the green light by the Prudential Authority to start offering banking services in South Africa. With more than 5,000 stores and over 10 million digital customers, Pepkor says it's perfectly positioned to reach people that traditional banks might miss. The firm's aim is to turn its huge retail footprint into a simple digital ecosystem where customers can shop, transact and manage their money in one place. The announcement comes alongside the release of Pepkor's annual results. The Ackermans owner has delivered record profit growth for the full year. Normalized headline earnings per share rose 23.4% to R1.61 during the period. The group attributes this to a strong operational performance and the successful execution of a number of strategic initiatives. A dividend of 53 cents per share has been declared, and that's up 9.2% on the previous period's payout. Pepkor says the results lay a strong foundation for the year ahead as it expands its digital ecosystem and rolls out up to 300 new stores. Octodec has delivered a solid set of annual results, reporting higher income and an improvement in earnings. The property group's distributable income rose to 456 million rand, up from 422 million rand last year, while distributable income per share grew 8% to 171 cents. The company has declared a total dividend of 134.5 cents for the year. Octodec says its portfolio of residential, retail, office and industrial properties in Tshwane and Johannesburg remains resilient, with net asset value per share edging up to 24.55 rand and its loan to value improving to 38.2%. The group says improved business confidence, low inflation and easing interest rates should support conditions in the year ahead, although large vacancies in its portfolio remain a challenge. And so it expects to achieve growth in distributable income and distribution per share in 2026 of between 0 and 4%. Strong, that's how Zeda has described its full year results. The Mobility and Automotive Solutions Company has posted a near 16% jump in headline earnings per share. This was driven by higher fleet utilization, disciplined cost management and strong growth in leasing, subscription and Greater Africa operations. A final dividend of R1.26 has been declared, and this takes the total for the year to R1.81. Looking ahead, the group plans to expand its Mobility and Africa operations, supported by technology, data and targeted investments across the region. Stefanuti Stocks has bounced back. For the 6 months to end August, headline earnings per share more than doubled to 34.5 cents, and that's thanks to better project performance and efficiency gains. No dividend has been declared as the company focuses on managing debt and its restructuring plan. And European new car sales increased by 4.9% in October, driven by a surge in electrical vehicle registrations, which outpaced petrol and diesel sales. Here's more detail in this package report.
New car sales in Europe rose 4.9% in October as electric cars outpaced petrol and diesel registrations. Data from the European Automobile Manufacturers Association showed on Tuesday that sales in the EU, Britain and the European Free Trade Association rose to over 1 million cars. Its largest markets, including Germany and Britain, added more new cars than last year. The European car industry has taken a series of hits this year. They include Donald Trump's trade tariffs, a slowdown in the Chinese market, and a slower than expected transition to electric vehicles. There have also been recent worries about a potential chip supply chain crisis surrounding Dutch chipmaker Nexperia. Registrations at Volkswagen and Stellantis rose year-on-year by 6.5% and 4.6% respectively, while Renault went up more than a tenth. Tesla sales, meanwhile, dropped by almost half from a year ago, while BYD's sales jumped a near 207%. And while electric and hybrids saw a boost, all major markets saw drops in their petrol and diesel registrations.